Hello, and welcome to today's episode of Finance Talks Podcast. I'm Ryan, and in today's episode, we'll be diving into one of the most crucial topics for anyone who's interested in investing: how to research stocks before making any purchases. Now, when you're thinking about investing in the stock market, there's no shortage of excitement. The idea of buying shares in a company, watching them grow in value, and ultimately achieving your financial goals can be exhilarating. But before you rush in and start buying stocks based on trends or tips from friends, it's important to pause and consider one essential factor. How do you really research the stocks you're interested in? This episode will give you a clear roadmap of the steps you need to take in order to properly evaluate any stock you're thinking of investing in.
Absolutely, Ryan. Whether you're a seasoned investor or just getting started, this process of researching stocks is critical for making well-informed decisions that can impact your financial future. Over the course of this podcast, we'll be walking you through the critical steps you should take before purchasing any stocks. We'll start by helping you understand the basics of financial statements, things like income statements, balance sheets, and cash flow statements, so you know exactly what to look for when assessing a company's financial health. We'll also delve into analyzing key financial ratios, because these are the numbers that can give you a snapshot of how well a company is performing. On top of that, we'll discuss how to assess market trends, which can be just as important as understanding the company itself, because the market and economic conditions play a huge role in a stock's performance.
Exactly, Priya. And what makes this episode even more valuable is that we won't just be talking theory. We'll also provide practical, real-world examples and clear strategies you can start using today. You'll learn how to look at a company's financials, understand what's behind their numbers, and figure out whether those numbers actually reflect long-term stability and growth potential. For instance, how do you figure out whether a company's stock is overpriced or undervalued? We'll explain the key metrics like the P/E ratio and why it's crucial to compare these metrics with industry standards. We'll also show you how to look beyond the numbers at things like the company's leadership, its competitive position in the market, and its growth prospects. By the time we're done, you'll not only know how to conduct your own research, but also how to analyze and interpret the data in a way that helps you make smarter, more informed decisions.
That's right, Ryan. And one of the most empowering things about learning how to properly research stocks is that it gives you a sense of control over your investments. A lot of people think investing is a gamble, but it's not. It's about making informed choices. Think of it like being the detective who gathers all the evidence before making a decision. By evaluating financial health, market conditions, leadership quality, and growth potential, you can significantly reduce your risks and feel much more confident in your choices. So whether you're looking to make your first stock purchase or refine your strategy, this episode will give you the tools to analyze stocks with a critical, data-driven mindset.
And that's exactly what we want for our listeners. Confidence. Confidence in your ability to sift through the noise of the market, the tips, the trends, and the speculative chatter, and instead focus on what really matters: the fundamentals of the company you're investing in. You don't need to be a financial expert to research stocks properly, but with the right framework, you can make decisions that are backed by logic and data, not just guesswork. By the end of today's episode, you'll have a clear step-by-step process for evaluating stocks, understanding the risks involved, and using that knowledge to make decisions that align with your financial goals. So, without further delay, let's jump right in and get started with the basics.
Investing in stocks is widely regarded as one of the most effective ways to build wealth over time. Stocks offer the potential for significant returns, and unlike other investment vehicles, they allow you to own a piece of a company. But with that potential comes risk. Stock prices can be volatile, and market conditions can change rapidly. Without proper research, an investor might end up buying stocks based on hearsay or a sudden surge in price, which could lead to significant losses. This is why researching stocks thoroughly is absolutely essential. It's not just about picking a stock based on a tip or a gut feeling. You need to take the time to understand the company behind the stock, its financial performance, and the broader market dynamics that could affect its future performance.
That's a great point, Priya. Many new investors make the mistake of jumping into stocks without considering these critical factors. But the truth is, the more research you do, the better equipped you'll be to make decisions that minimize risk and maximize potential returns. Think of stock research as a way of lowering your investment risk. By understanding the financial health of the company, you can assess its ability to weather market fluctuations, handle economic downturns, and continue growing in the long term. This allows you to invest with confidence, knowing that your choices are backed by solid data and not just short-term trends or speculation.
Exactly, Ryan. When you commit your money to a stock, you're not just buying a piece of paper or a number on your brokerage account, you're investing in a real business. And just like you'd research any major purchase in your life, like a home or a car, you need to do the same with stocks. It's essential to understand the business behind the stock. What do they do? How do they make money? What differentiates them from their competitors? A thorough understanding of these aspects will help you gauge whether the company has a competitive edge in its industry, whether it's positioned for growth, and whether it has a strong management team in place to drive its future success.
That's so important, Priya, understanding the business itself. But it's also crucial to look at the company's financial health. Is it profitable? Does it have a solid balance sheet? Does it generate enough cash flow to support its operations and growth? These are key questions that can tell you whether a company is in a strong position or at risk of running into financial trouble. Even a company that seems promising on the surface might be struggling behind the scenes if its financials aren't in order. So it's vital to look closely at things like its revenue, earnings growth, debt levels, and cash flow before you invest your money.
Absolutely, Ryan. And don't forget about the broader market conditions either. A company can be performing well, but if the overall market or the industry it operates in is struggling, it could still face challenges. For example, if there's an economic downturn or a shift in consumer preferences, even the best companies might see their stock prices drop. This is why researching market trends and understanding the broader economic environment is just as important as looking at a company's financial health. By staying informed about market conditions, interest rates, inflation, and global events, you'll be better equipped to predict how these factors might affect your investment.
Exactly, Priya. In essence, researching stocks helps you see the full picture. It's about connecting the dots between a company's performance, its financial health, its competitive position in the market, and how external factors could influence its success. By having a deeper understanding of all these elements, you'll be able to make more informed decisions that align with your financial goals. Instead of making decisions based on hype or emotion, you'll have the knowledge to back up your choices, which is essential for long-term investment success. Let's start by understanding the fundamentals. When you buy a stock, you're essentially buying a small part of a company. Think of it as owning a piece of the business. But it's important to understand that not all stocks are the same, and there are different types that serve different purposes for investors. The first thing we need to clarify is, what exactly is a stock? A stock represents ownership in a company. When you purchase a share of stock, you're buying a slice of the company. If the company grows and becomes more profitable, the value of your stock can increase as well. On the other hand, if the company underperforms or faces challenges, the value of your stock might decrease. Essentially, buying stock makes you a shareholder, meaning you have a claim on the company's assets and earnings.
Exactly, Ryan. And when we talk about stocks, there are two main types: common and preferred stocks. Let's start with common stocks. This is the most common type of stock that people invest in. When you own common stock, you typically get voting rights, meaning you can vote on key company matters like electing board members or approving major business decisions. Common stocks can also offer dividends, though these dividends are not guaranteed. They're usually paid out from the company's profits, but if the company faces financial difficulties, dividends can be reduced or even eliminated. However, owning common stock gives you exposure to the company's potential growth. So there's greater opportunity for higher returns, but also greater risk.
Right, Priya. Now, let's talk about preferred stocks. These are a bit different. Preferred stocks don't generally offer voting rights, so as a shareholder, you don't have a say in the company's decisions. However, preferred stocks come with some benefits, especially when it comes to dividends. Companies are more likely to pay out dividends to preferred shareholders before common shareholders, and preferred shareholders typically receive a higher dividend payout. If the company were to go bankrupt or liquidate its assets, preferred shareholders have a higher claim on the company's assets compared to common stockholders. While preferred stocks offer more stability in terms of dividends and a claim on assets, they generally don't have the same growth potential as common stocks.
So, to recap, common stocks give you ownership in the company, voting rights, and the potential for dividends and growth. However, they also come with the risk of volatility. On the other hand, preferred stocks offer more stability in terms of dividends and a higher claim on assets, but they lack voting rights and typically don't see the same level of price appreciation over time. Both types of stocks have their place in an investor's portfolio, depending on their financial goals and risk tolerance. Now that we understand what stocks are and the different types, it's time to dive deeper into stock research itself.
Exactly, Priya. Stock research means more than just checking price movements on a stock chart. It's about digging deep into the company's operations, its financial health, and understanding the factors that might influence its future potential. When you're researching a stock, you want to go beyond the headlines and look at the fundamentals, the things that tell you whether the stock is a good investment for your portfolio. A lot of people get caught up in price movements or rumors about a stock, but that doesn't give you the full picture. Researching a stock means taking a closer look at its financials, the industry it operates in, its competitors, its management, and its growth prospects.
That's right, Ryan. The goal of stock research is to identify whether a stock fits with your investment strategy. For example, if you're looking for long-term growth, you'll want to focus on companies that are positioned to grow steadily over the years. This might mean researching companies in industries that are expanding, or companies with strong leadership and a track record of innovation. On the other hand, if your strategy is focused on generating income through dividends, you'll want to look for companies that have a stable history of paying out dividends and a strong balance sheet to support those payments. If you're looking for a quick trade, then you might focus more on short-term trends and technical analysis.
Exactly, Priya. Your research should be aligned with your overall investment goals. The goal isn't just to pick a stock randomly, but to choose one that fits into your strategy, whether that's for long-term growth, consistent dividends, or even short-term trades. For example, some investors might look for companies that have low debt and high cash flow if they want steady, long-term returns. Others might focus on companies in emerging sectors that could potentially deliver higher growth, but also come with higher risk. The key is to understand what you're aiming for and do your research accordingly.
Now that we understand the basics, let's dive into the core of stock research: financial health. When you're evaluating stocks, one of the most important aspects to consider is how financially stable and profitable the company is. A company could have a great product or service, but if it doesn't have solid financials, it might struggle to stay afloat in the long term. So, the first thing we need to look at is the income statement. But what exactly is an income statement? An income statement is a financial document that shows a company's revenues, expenses, and profits over a specific period, usually a quarter or a year. It tells you how much money the company is bringing in, how much it's spending, and whether it's generating profit or running into losses.
That's right, Priya. Now, when you're looking at an income statement, there are certain things you'll want to focus on to get a good sense of the company's financial health. First and foremost, look at revenue growth. Revenue is the amount of money a company makes from its primary business activities, and a steady increase in revenue is generally a good sign that the company is growing. You want to see a consistent upward trend in revenue over time. A company might face short-term fluctuations, but if it's growing steadily over the long term, that's a positive sign. Also, pay attention to profit margins. Profit margins tell you how efficiently the company is turning its revenue into profit. A higher profit margin means the company is doing a better job at managing its expenses and turning sales into actual profits.
Exactly, Ryan. And another important metric on the income statement is operating income. This is the money the company makes from its core business activities before accounting for interest, taxes, and other non-operating expenses. Looking at trends in operating income can give you a sense of whether the company's core operations are becoming more profitable. If you see that operating income is consistently increasing, it's a good sign that the company's business model is working and its cost management is improving. On the flip side, if operating income is shrinking, it might indicate that the company is struggling to maintain its profit generation or facing increasing costs.
Right, Priya. So, if a company's revenue is growing steadily and its profit margins are expanding, that's a positive indicator. It shows that the company is not only increasing sales but also managing its costs efficiently. Trends are key here. Look for consistent growth rather than one-off spikes or dips. Additionally, don't ignore the bottom line, the net income or profit at the end of the income statement. This is the amount of money the company is left with after all expenses are accounted for. Positive net income over time is a good sign, but keep in mind that one bad quarter doesn't necessarily spell disaster. Consistency is the key. And if the company is showing consistent growth in net income, you're looking at a company that's likely managing its business well.
Exactly, Ryan. So, to sum up the income statement, we're looking for three main things: revenue growth, profit margins, and operating income trends. These are all signals that the company is performing well and managing its financials effectively. A strong income statement is a foundational piece of a company's overall financial health and will give you a good indication of whether it's worth investing in.
Now, let's move on to the next key financial statement: the balance sheet. The balance sheet is another important tool for evaluating a company's financial health. It provides a snapshot of the company's assets, liabilities, and shareholders' equity at a specific point in time. Unlike the income statement, which covers a period of time, the balance sheet gives you a snapshot of the company's financial position at a single point in time, usually at the end of a fiscal quarter or year.
And when you're looking at the balance sheet, one of the most critical things to evaluate is the company's debt. You want to know how much debt the company is carrying and how it compares to its assets. A company with too much debt might struggle to pay it off, especially if its revenue drops or if market conditions become unfavorable. Look at the debt-to-equity ratio, which compares the company's total liabilities to its shareholders' equity. A high debt-to-equity ratio can be a warning sign that the company is overly reliant on debt to finance its operations, which can increase risk, especially in turbulent economic times.
That's a great point, Priya. On the flip side, a company with little debt may be in a strong financial position, but it could also indicate that the company is under-leveraged, which means it might not be using available credit to fuel growth opportunities. So the key is balance. You want to find a company with manageable levels of debt that it can easily service with its earnings. Another important metric on the balance sheet is cash and cash equivalents. Cash is king, especially in uncertain market conditions. A company with a strong cash position has the flexibility to weather downturns, invest in growth, and avoid taking on unnecessary debt.
Exactly, Ryan. A solid balance sheet is crucial because it tells you how financially stable a company is and whether it has the ability to weather financial storms. Companies with a healthy balance sheet are in a better position to withstand economic downturns, invest in innovation, and deliver consistent returns to shareholders. Now, let's move on to the final key financial statement, the cash flow statement.
Yes, the cash flow statement is just as important as the income statement and balance sheet, but it focuses on how cash is moving in and out of the company. This statement provides insights into the company's ability to generate cash from its operations, which is crucial because cash is the lifeblood of any business. Without enough cash flow, even the most profitable companies can run into serious problems. There are three main sections on the cash flow statement: operating activities, investing activities, and financing activities.
Now that we've covered the income statement, let's move on to the balance sheet, another key tool for evaluating a company's financial health. The balance sheet provides a snapshot of a company's financial position at a specific point in time. Unlike the income statement, which shows a company's performance over a period, the balance sheet shows the company's assets, liabilities, and shareholder equity at a single moment, usually at the end of a fiscal quarter or year. Think of it as a photograph of the company's finances on a particular day. The balance sheet is divided into two main sections: what the company owns, its assets, and what it owes, its liabilities. The difference between the two is called shareholder equity, which represents the owner's claim after all debts have been paid.
Exactly, Priya. When analyzing the balance sheet, one of the most important things to look at is the company's debt, specifically the debt-to-equity ratio. This ratio compares the amount of debt a company has to the amount of equity or shareholder investment in the business. A high debt-to-equity ratio can be a red flag, especially if interest rates are rising. Why? Because a company with a lot of debt is going to face higher interest payments as rates increase, and if the company's revenues don't grow enough to cover those rising costs, it could get into financial trouble. Companies with high debt levels might also struggle to access additional financing or face restrictions on borrowing, which can limit their ability to grow or weather economic downturns.
That's a crucial point, Ryan. Rising interest rates can make it more expensive for companies to service their debt, which is why it's important to keep an eye on the debt-to-equity ratio. But it's not just about the debt. You also need to pay attention to the company's assets versus its liabilities. The ratio between these two components tells you how well-positioned the company is to cover its obligations. If a company's liabilities are higher than its assets, it could indicate financial trouble. On the other hand, if the company has more assets than liabilities, it suggests the company is financially stable and can easily meet its obligations, even in difficult times. So, when you're analyzing the balance sheet, make sure to understand the company's leverage and whether its assets are enough to cover its debts.
Absolutely, Priya. Now, the assets section is divided into two parts: current assets and non-current assets. Current assets are those that are expected to be converted into cash or used up within the next 12 months, like cash, accounts receivable, and inventory. Non-current assets, on the other hand, are long-term investments, such as property, equipment, and intellectual property. It's important to look at the mix of these assets. A company with a high proportion of current assets might be in a better liquidity position, meaning it can easily cover short-term obligations. But if a company has too many non-current assets, especially if they're not generating revenue, it could be a warning sign that the company is relying too much on long-term assets that are harder to liquidate.
Right, Ryan. Understanding the balance sheet's asset composition gives you insight into the company's ability to cover its short-term and long-term obligations. A healthy balance sheet typically shows a balance between current and non-current assets. But remember, not all assets are created equal. For example, intangible assets like patents or goodwill can be difficult to value and might not provide immediate cash flow. Inventory, while considered a current asset, can become problematic if it's unsold, or if the company has too much inventory that's not moving. So, it's also important to look at how the company is managing its assets to generate income.
Exactly, Priya. So, when you look at the balance sheet, you want to assess both the company's debt levels and its asset management. If the company is carrying a lot of debt, but also has a solid mix of assets that are generating revenue, it might still be in a good position. But if the debt is too high and the assets aren't productive enough, it can indicate trouble ahead. The key is to find a balance where the company is not over-leveraged and has the necessary assets to support its operations and growth.
And don't forget the shareholder equity at the bottom of the balance sheet. This is the portion of the company that belongs to the shareholders after all liabilities have been subtracted from assets. A growing equity position indicates that the company is increasing its value over time. But if equity is declining, it could signal that the company is losing value or struggling to generate returns for shareholders. In other words, positive shareholder equity is a good sign, but negative shareholder equity is a red flag that warrants further investigation.
Exactly, Priya. So, to sum up, when evaluating the balance sheet, focus on the debt-to-equity ratio, how the company's assets compare to its liabilities, and the overall health of the company's shareholder equity. A strong balance sheet will show that the company is well managed, has a good mix of assets and liabilities, and is in a position to continue growing and generating returns for shareholders. But if the company is over-leveraged or its assets aren't efficiently managed, it could be a sign that the company's financial health is at risk.
Now that we've gone over the income statement and balance sheet, it's time to dive into the cash flow statement, which is just as important as the other two. The cash flow statement provides insights into how money is flowing in and out of a company. While the income statement tells you whether a company is profitable, the cash flow statement shows whether it's actually generating cash. After all, a company can report a profit on its income statement, but if it isn't generating enough cash, it could still run into trouble. Cash is the lifeblood of any business. Without enough of it, even the most profitable companies can face difficulties paying their bills or funding growth initiatives.
Exactly, Priya. The cash flow statement is divided into three main sections: operating activities, investing activities, and financing activities. The first section, operating activities, focuses on the cash generated by the company's core business operations. This is the cash the company makes from selling goods and services, minus the cash it spends on running the business. If a company has strong cash flow from operations, it's an indication that the business itself is healthy and generating enough money to support its daily activities.
Right, Ryan. But there's more to it than just looking at the cash generated from operations. Another key metric to pay attention to is free cash flow. Free cash flow is the money the company generates from its operations after deducting capital expenditures. Those are the funds spent on things like equipment, infrastructure, or anything that is needed to sustain or grow the business. Free cash flow is a critical measure because it indicates how much cash is available for growth initiatives, paying dividends, or reducing debt. In other words, free cash flow is what gives the company the flexibility to invest in its future or return value to shareholders.
That's a great point, Priya. A company with strong free cash flow has the ability to reinvest in itself, whether it's by expanding operations, developing new products, or acquiring other companies. It can also use that cash to pay down debt, which improves its financial stability. And don't forget about the potential to return value to shareholders. Strong free cash flow means the company has the ability to pay dividends. This is especially important for investors who are looking for income from their investments, as dividends can be a reliable source of cash flow over time.
Exactly, Ryan. If a company has consistent, growing free cash flow, it's a good sign that the business is in a strong position to weather economic downturns and continue growing. But if a company is struggling with free cash flow, maybe it's not generating enough cash from operations, or it's spending too much on capital expenditures. This could be a red flag. It might indicate that the company is in financial trouble, or that it won't be able to sustain its current level of operations or growth. Investors should look for companies with stable and growing free cash flow, as this indicates financial health and long-term sustainability.
Absolutely, Priya. Now, let's take a look at the other two sections of the cash flow statement. The investing activities section shows how much cash the company is spending or receiving from investments, such as buying or selling assets, like property, equipment, or other companies. This section can give you insights into whether the company is expanding its operations or divesting assets to focus on its core business. If a company is investing heavily in its future, this could be a good sign that it's positioning itself for growth, although it could also indicate that the company is spending a lot of money up front with the hope that it will pay off in the future.
Right, Ryan. The investing activities section can also provide insight into how the company is managing its capital expenditures. For example, if a company is investing a lot of money in new equipment or infrastructure, it could be preparing for future growth. However, if a company is divesting assets or scaling back its investments, it could indicate that it's struggling or that it's trying to streamline its operations. It's important to look at the overall trend in this section, whether the company is consistently investing for future growth or whether it's scaling back, which could suggest a lack of confidence in its business model or market conditions.
Exactly, Priya. Lastly, the financing activities section of the cash flow statement shows how much cash the company is raising or paying out through external financing. This includes things like issuing or repurchasing stock, borrowing money, or paying down debt. A company that is consistently issuing stock or taking on debt might be trying to raise capital to fund growth, but it could also be a sign that the company is struggling to generate enough cash from its operations. On the other hand, a company that is paying down debt or repurchasing stock might be signaling that it's in a strong financial position and has excess cash to return value to shareholders.
Right, Ryan. And just like with the other sections of the cash flow statement, you want to look at the trends over time. If a company is consistently raising money through debt or equity offerings, it might indicate that it's not generating enough cash internally to fund its operations or growth. But if a company is paying down debt or repurchasing stock, it could indicate financial strength and a commitment to rewarding shareholders. So, by looking at all three sections of the cash flow statement, operating, investing, and financing activities, you can get a well-rounded picture of how the company is managing its cash and whether it's in a good position for future growth.
And the beauty of these three financial statements, the income statement, balance sheet, and cash flow statement, is that you can use them together to get a complete picture of a company's financial health. While the income statement shows you whether the company is profitable, the balance sheet tells you about its financial stability, and the cash flow statement gives you insight into its liquidity and ability to generate cash. By analyzing all three together, you can assess the company's profitability, growth potential, and financial stability, which will help you make more informed decisions when researching stocks.
Next, we'll dive into financial ratios, which are key tools in stock research. These ratios help investors assess a company's financial performance and provide insights that numbers alone can't always give you. By using these ratios, you can better understand a company's profitability, efficiency, and valuation. Now, one of the most commonly used ratios in stock analysis is the price-to-earnings, PE ratio. This ratio measures the stock price relative to its earnings, helping investors gauge whether a stock is priced appropriately given its profitability. In other words, it tells you how much investors are willing to pay for a company's earnings.
Exactly, Priya. The PE ratio is calculated by dividing the current stock price by the company's earnings per share. For example, if a company's stock is trading at $100 and its earnings per share is $5, its PE ratio would be 20. This means investors are willing to pay 20 times the company's earnings for a share of its stock. The PE ratio can give you an idea of how the market values the company in relation to its earnings. A high PE ratio can sometimes indicate that a stock is overvalued, meaning investors are expecting high growth in the future, but they might be paying a premium for that potential growth. On the other hand, a low PE ratio could suggest that the stock is undervalued, but it could also mean that the company is experiencing problems or that the market is not confident in its future prospects.
That's right, Ryan. But here's a crucial point. You can't judge the PE ratio in isolation. It's important to compare it to the company's historical PE ratio, as well as to the PE ratios of competitors or industry averages. For instance, if a company has a PE ratio of 30, but its competitors are all around 15, that could be a sign that the stock is overvalued, especially if the company's growth prospects aren't significantly better than its peers. But if the company has a higher PE ratio because it's in a high-growth sector, like technology or biotech, it could be justified. So, while the PE ratio is a helpful starting point, it's just one piece of the puzzle.
Exactly. It's important to use the PE ratio alongside other ratios and metrics to get a clearer picture of a company's valuation. For example, let's look at the price-to-sales, PS ratio. This ratio measures the stock price relative to the company's revenue rather than earnings. The PS ratio is calculated by dividing the market capitalization by total revenue. This is particularly useful for companies that are not yet profitable but still have strong revenue growth. A high PS ratio could indicate that investors are expecting strong future sales growth, while a low PS ratio could suggest undervaluation or that the company is struggling to generate revenue.
That's a great point, Ryan. The PS ratio can be a helpful tool, especially when analyzing young or growth stage companies that might not have profits yet but have strong revenue potential. However, just like with the PE ratio, the PS ratio needs to be compared to industry averages and competitors. Some industries, like tech or consumer goods, might have higher PS ratios due to their growth potential, while more stable industries like utilities may have lower PS ratios. So the P to S ratio should be considered in context.
Now, another important ratio to look at is the debt-to-equity DE ratio. This ratio compares a company's total debt to its shareholder equity. It's a measure of the company's financial leverage and indicates how much of the company's financing comes from debt versus equity. A high DE ratio could suggest that the company is taking on a lot of debt to finance its growth, which can be risky, especially if interest rates are rising or if the company's cash flow isn't strong enough to service that debt. On the other hand, a low DE ratio might suggest that the company is more conservative with its financing, relying more on equity, which can be a sign of financial stability.
Exactly, Ryan. The DE ratio is a key indicator of risk. A company with a high debt load might be more vulnerable to economic downturns or increases in interest rates, as it will have to make higher interest payments. On the other hand, a company with little debt might be in a more stable position, but could also be missing out on opportunities to leverage debt to fuel growth. Like other ratios, the DE ratio should be compared to industry standards. Some sectors, like utilities, tend to have higher DE ratios because they require large capital investments, while tech companies generally have lower DE ratios because they rely more on equity financing.
Absolutely. Now let's also discuss the return on equity ratio. This is a measure of how effectively a company is using shareholders' equity to generate profits. Return on equity is calculated by dividing net income by shareholder equity. A high ROE indicates that the company is efficiently using its equity to generate profits, which is generally a positive sign. However, it's important to look at trends over time. If a company's ROE is high but declining, it could indicate that the company is facing challenges in maintaining profitability. A consistently high ROE is a sign of effective management and strong operational performance.
Exactly, Ryan. The ROE ratio is a great indicator of how well a company is managed and how effectively it's utilizing investor capital. However, just like with the other ratios, you should look at ROE in the context of the industry. Some industries, like financial services, tend to have higher ROE ratios, while others, like manufacturing, may have lower ROE ratios. That's why it's important to compare the company's ROE with its peers or the industry average.
So, to summarize, when analyzing financial ratios, always compare them to the company's historical performance, industry averages, and competitors. Key ratios like the PE ratio, PS ratio, DE ratio, and ROE can give you valuable insights into a company's valuation, profitability, and financial health. But remember, no single ratio tells the whole story. Use these ratios together to get a more comprehensive understanding of the company's performance and whether it's a good investment opportunity.
Now, let's talk about another key financial ratio: the debt-to-equity, DE, ratio. This ratio compares a company's total debt to its shareholder equity. Essentially, it shows the proportion of debt the company is using to finance its operations compared to the money that investors have put in. It's an important measure because it tells you how much leverage a company is using. In simple terms, leverage is the use of borrowed money to finance the company's growth or operations. So, when we look at the DE ratio, we're assessing the company's reliance on debt to fuel its business.
Exactly, Priya. The formula for the DE ratio is pretty straightforward. You divide the company's total debt by its shareholder equity. A D/E ratio of 1.0 means the company has an equal amount of debt and equity. A ratio above 1.0 suggests that the company is more debt-heavy than equity-heavy. The higher the ratio, the more the company is relying on debt to finance its activities. A high DE ratio might seem appealing because it could indicate that the company is aggressively leveraging debt to fund growth, which can lead to higher returns if managed well. However, it also increases financial risk especially in volatile market conditions.
That's right, Ryan. A high DE ratio means that the company is borrowing a lot of money, which could be risky, particularly if the company faces a downturn in the market or industry. If the company's revenues decline or its costs increase, the burden of servicing that debt, paying interest and repaying the principal, becomes harder. This could lead to financial distress or even bankruptcy in extreme cases. So, if you see a company with a DE ratio above 1.0, it's important to look deeper into the company's financial health and its ability to manage its debt, particularly in uncertain economic conditions.
Right, Priya. On the flip side, a low DE ratio generally indicates that the company is relying more on equity financing, which can be a sign of financial prudence and stability. A low ratio suggests that the company isn't taking on a lot of debt, which reduces the risk of defaulting on obligations if times get tough. But there's a trade-off here, too. If a company has a very low DE ratio, it might not be taking full advantage of debt to fuel growth. Debt can be a useful tool for expanding a business without diluting ownership through issuing more equity. So, while low debt can reduce financial risk, it could also indicate missed opportunities for leveraging debt to enhance returns.
Exactly, Ryan. So, what we're really looking for is a balanced approach. A company's DE ratio should be in line with its industry averages and its long-term financial strategy. For example, in capital-intensive industries like utilities or real estate, companies tend to have higher DE ratios because they require a lot of upfront capital for infrastructure and expansion. In contrast, technology companies might have lower DE ratios because their capital needs are often lower, and they can generate strong cash flow without heavy borrowing. So, context is key.
Right, Priya. The DE ratio should also be looked at over time. If a company's ratio is rising steadily, it could be a warning sign that it's becoming too reliant on debt. But if the ratio is stable or decreasing, it could indicate that the company is managing its debt well. And remember, it's always a good idea to compare the company's DE ratio to its peers in the same industry. A high DE ratio might not be as concerning if other companies in the same sector also have high debt levels due to the nature of the industry.
Exactly, Ryan. The bottom line is that the DE ratio gives you insight into a company's financial risk and its use of leverage. A higher ratio means more risk, but it could also mean higher returns if the company can handle its debt effectively. A lower ratio indicates less risk, but could suggest that the company isn't leveraging debt for growth opportunities. So, when you're researching stocks, the DE ratio is a key metric to evaluate, but it should always be considered alongside other ratios and the company's overall financial strategy.
Next, let's dive into return on equity, or ROE. This ratio measures how efficiently a company uses its shareholder equity to generate profits. In other words, ROE shows how well a company is utilizing the money invested by its shareholders to produce earnings. It's a great way to assess management's ability to turn equity into profit. The formula for ROE is pretty straightforward. You divide a company's net income by shareholder equity. A higher ROE generally means that the company is using its resources more effectively to generate earnings and is doing a good job of creating value for its shareholders.
Exactly, Ryan. The ROE ratio gives you a snapshot of the company's profitability in relation to its equity. For example, if a company has a net income of $10 million and shareholder equity of $50 million, its ROE would be 20%. This means that for every dollar invested by shareholders, the company is generating 20 cents in profit. A higher ROE is generally a good sign, indicating that the company is able to produce a strong return on the capital provided by its shareholders. However, it's important to note that a very high ROE can also raise some questions, as it may be a sign of a company taking on too much debt or using aggressive accounting practices.
That's an excellent point, Priya. While a high ROE is generally seen as a positive indicator of efficiency and profitability, it's essential to take a closer look at the components driving that ROE. For instance, if a company has a high ROE due to significant debt, it could be a red flag. High levels of debt can artificially inflate ROE because the company's equity is reduced. In such cases, the company may not be generating profits purely from its operations, but rather from the leverage provided by debt. This is why it's important to look at the company's debt-to-equity ratio alongside the ROE to understand if the high return is being driven by leverage.
Absolutely, Ryan. And another thing to consider is the industry context. Different industries have different standards for what constitutes a good ROE. For example, technology companies tend to have higher ROE compared to more capital-intensive industries like manufacturing or utilities, which might have lower ROE due to their need for substantial investments in infrastructure and equipment. So, when evaluating ROE, it's important to compare a company's performance to others in the same industry to get a true sense of its efficiency.
That's a great point, Priya. When you're looking at ROE, it's crucial to benchmark it against industry averages and historical performance. A consistent and growing ROE over time is often a sign of strong management and sustainable business operations. However, if a company's ROE is declining, it could indicate that its profitability is weakening, or that it's facing increasing challenges in generating returns on its equity. Tracking ROE over multiple quarters or years will give you a better idea of the company's performance and its ability to generate consistent profits.
Right, Ryan. Another important factor is the quality of the earnings that contribute to the ROE. Earnings that are sustainable and come from core business operations are far more valuable than one-time gains or non-recurring income. If a company is consistently posting high ROE, but it's driven by extraordinary items like the sale of assets or a tax windfall, the ratio might not be a true reflection of its ongoing profitability. It's always better to see a company with a steady and sustainable ROE driven by strong operational performance.
Exactly, Priya. So to sum up, ROE is a powerful indicator of how well a company is using its equity to generate profits. A high ROE is generally positive, but it's important to dig deeper and assess how it's being achieved, whether it's through efficient operations or heavy reliance on debt. And don't forget the importance of industry comparisons and looking at the company's historical performance. ROE, when used alongside other financial metrics, gives you a clearer picture of a company's financial health and management effectiveness.
Now let's move on to another important financial ratio, the price-to-book. PB ratio. The PB ratio compares the market value of a company's stock to its book value. The formula is simple. You divide the company's market price per share by its book value per share, which is the difference between the company's total assets and its total liabilities. In essence, the PB ratio tells you how much investors are willing to pay for each dollar of a company's net assets. If a company has a PB ratio of 2, that means investors are paying $2 for every dollar of book value. This ratio is especially useful when you're analyzing companies that have a lot of physical assets, like banks, manufacturing companies, or real estate firms.
That's a great overview, Priya. The PB ratio is particularly helpful because it helps investors assess whether a stock is overvalued or undervalued based on the company's net worth. If the PB ratio is under 1, it could be a sign that the stock is undervalued, meaning you're buying it for less than its book value. But as with all ratios, we need to dig deeper. A PB ratio under 1 might sound like a bargain, but it doesn't always indicate a good buying opportunity. In some cases, it could mean that investors have lost confidence in the company's assets or its ability to generate profits in the future. So while the ratio may suggest undervaluation, you need to carefully analyze the company's assets and whether they are truly valuable.
Exactly, Ryan. The PB ratio can also highlight potential issues with a company's balance sheet. For instance, if the company's assets are intangible, like intellectual property, goodwill, or brand value, the book value might not reflect their true worth. A low PB ratio in such cases could be misleading because it doesn't account for the potential value of these intangible assets. On the other hand, if the company has a lot of non-performing or depreciating assets, the low PB ratio might be justified. That's why it's crucial to look at the company's asset quality and the context behind the ratio.
Right, Priya. A PB ratio under 1 can also indicate that the company is experiencing difficulties. It could be a sign of a declining business model, poor management, or an industry in decline. So, while it might seem like a good deal at first glance, it's important to investigate why the market is valuing the company below its book value. It could be that the market is anticipating further losses or that the company's assets are being overestimated on the books. Sometimes it's better to avoid stocks with a very low PB ratio unless you've thoroughly analyzed the situation and the company's potential for recovery.
Exactly. A high PB ratio, on the other hand, can signal that the stock is overvalued relative to its book value, but not necessarily in a bad way. It could mean that investors are placing a premium on the company's intangible assets, such as strong brand equity or intellectual property. For example, tech companies or startups often have high PB ratios because their assets, like patents or software, are not fully reflected on the balance sheet. So, in these cases, a high PB ratio can indicate that the market has high expectations for the company's future growth.
That's right, Priya. And when evaluating the PB ratio, it's important to compare it to industry peers. A company might have a high PB ratio, but if it's in an industry where intangible assets are highly valued, like technology or pharmaceuticals, it might not be a cause for concern. Similarly, comparing a company's PB ratio to its historical average can give you a sense of whether the stock is overpriced or undervalued relative to its past performance.
Exactly, Ryan. So the PB ratio gives us a good sense of how the market values a company's tangible assets. However, we need to consider the quality of those assets, the company's future prospects, and industry-specific factors before making any conclusions. It's another tool in our toolkit for evaluating stocks, but like all ratios, it should be used in conjunction with other metrics to form a comprehensive view of the company.
After evaluating a company's financial health, the next step in our stock research process is understanding its position within the broader market and industry. You can have a company with fantastic financials, but if it's operating in an unfavorable market environment, its potential for growth can be significantly impacted. So, one of the first things you need to consider is macro trends, which are large-scale economic factors that can influence a whole sector or the market as a whole. Macro trends include things like interest rates, inflation, economic growth, and unemployment rates. These trends affect how businesses operate and, ultimately, how their stock prices perform. Understanding these can give you a much clearer picture of whether the company you're interested in is well positioned to thrive or could face headwinds.
Exactly, Ryan. Macro trends are critical because they provide a broader economic context that impacts all companies within a certain sector. For instance, let's talk about interest rates. When central banks raise interest rates, borrowing becomes more expensive. This impacts companies that rely heavily on loans for expansion. So, for sectors like technology or real estate, where companies often need financing to fuel growth, rising interest rates could create serious challenges. If borrowing costs increase, companies may scale back their expansion plans, or they may face higher operating costs as they try to service existing debt. This in turn can put pressure on their profitability and, ultimately, their stock prices.
Right, Priya. For example, we've seen technology companies in particular struggle when interest rates rise. They often rely on cheap capital to fund their aggressive growth strategies. Think about those tech giants pouring money into research and development or expanding infrastructure. Higher interest rates make this financing more expensive, and they also raise concerns about future profitability. Additionally, these companies may face increased competition as startups that also rely on borrowed capital may have a harder time securing funding. So, when you're researching stocks, it's crucial to think about how rising interest rates or any macroeconomic changes could impact the cost of capital for the company you're looking at.
That's a great point, Ryan. Another macro trend to consider is inflation. Inflation refers to the overall increase in prices within an economy, and it impacts businesses in many ways. For one, inflation increases the cost of raw materials and labor. For example, companies in the manufacturing or consumer goods sectors might see higher costs for things like steel, oil, or labor as inflation rises. These increased costs often get passed on to consumers in the form of higher prices. However, this can backfire if consumers start cutting back on spending due to higher prices, which can hurt companies' revenues and profit margins. So, as an investor, it's important to consider how inflation might affect the profitability and pricing power of the company you're researching.
Exactly, Priya. Inflation can be a double-edged sword. On one hand, it can lead to higher prices, which might seem good for companies if they can pass those costs on to consumers. On the other hand, if inflation becomes too high, consumers may cut back on spending, leading to decreased demand. This is particularly important in sectors that depend on consumer spending, such as retail and hospitality. In these cases, even if the company's financials look solid, a sharp rise in inflation could drastically reduce future growth expectations. So, inflation is one of those macroeconomic factors that can have a direct impact on a company's revenue and stock price.
Absolutely, Ryan. And we also need to consider economic growth. During periods of strong economic growth, most companies benefit from increased consumer spending, higher demand for products and services, and greater business investments. On the flip side, during economic downturns or recessions, companies may struggle as demand for goods and services declines. For example, sectors like luxury goods or travel may suffer during a recession as people cut back on discretionary spending. Conversely, during a boom, these sectors can see huge growth as consumers have more disposable income. As an investor, understanding the economic cycle and the stage of the cycle can help you gauge whether a company is well-positioned to thrive or if it could be at risk.
That's right, Priya. Economic growth affects virtually every industry, but some industries react more sensitively to economic cycles than others. For example, consumer staples, like food and household products, tend to do well during both good and bad times because people still need to buy the essentials. On the other hand, industries like automobiles or luxury goods can experience a slowdown during tough economic times. So, while you may see a promising company, you also need to analyze whether the current economic conditions are favorable for its business model. It's all about understanding how external factors like interest rates, inflation, and economic growth can influence the company's prospects. After evaluating the company's financial health, the next step is understanding its position within the market and industry. It's crucial to assess how broader market forces and specific industry trends might impact the company's future performance. One of the first things we need to look at are the macro trends, which refer to the larger economic conditions that affect the overall market. These include factors like interest rates, inflation, and economic growth. These macroeconomic elements have a significant influence on industries and companies, so keeping an eye on them will help you make informed decisions.
Exactly, Ryan. Macro trends are especially important because they can affect the entire market, not just individual companies. For example, if interest rates rise, it becomes more expensive for companies to borrow money. This can negatively impact industries that rely on heavy borrowing to fuel expansion and innovation. A great example of this would be the technology sector. Tech companies often rely on loans or credit to fund their research and development, so rising interest rates can increase their operational costs. This, in turn, could affect their profitability and stock prices.
Right, Priya. Another key factor is inflation, which impacts purchasing power and can drive up costs for companies. If the cost of raw materials or labor increases, companies might see their profit margins shrink. For example, industries like consumer goods or manufacturing might feel the pinch more than others when inflation is high. Economic growth is another big one. If the economy is expanding, companies across various sectors might experience an uptick in demand for their products or services. On the flip side, during periods of economic downturns, consumer spending decreases, and many companies might face challenges as a result.
That's a great point, Ryan. So, Understanding macro trends allows us to see the bigger picture and how external factors could impact the company we're researching. Now, once you've got a handle on the broader economic environment, it's time to focus on industry-specific trends. This means diving deeper into the particular sector in which the company operates and understanding the forces that are driving or hindering growth within that industry.
Exactly, Priya. Industry trends are critical because they can help you assess the growth potential of the sector and whether the company is well-positioned to capitalize on those trends. For example, let's consider renewable energy stocks. This sector is currently experiencing a growth phase due to increasing global demand for clean energy solutions and the push for sustainability. Companies in this space are likely to benefit from government incentives, innovations in technology, and growing environmental concerns. If you're looking at a renewable energy company, understanding these trends will help you gauge its future prospects.
That's an important observation, Ryan. On the other hand, some industries may face headwinds due to factors like regulatory challenges, market saturation, or declining demand. A good example is the traditional energy sector, like oil and gas. While this industry has been a cornerstone of global economies for years, it's facing increasing pressure from environmental regulations and the growing shift towards renewable energy sources. Companies in this space might find it harder to sustain growth or maintain profitability in the face of such challenges.
Exactly. And to build on that, when you're assessing industry trends, look for new technologies, consumer behaviors, or regulations that might shape the industry's future. For example, the automobile industry is shifting towards electric vehicles, EVs, and companies that are investing in EV technology are likely to be in a better position as the market moves in that direction. Similarly, in the healthcare sector, advancements in biotechnology and personalized medicine are transforming the landscape. Being aware of these emerging trends gives you insight into which companies are poised for growth and which might be left behind.
Right, Ryan. So, to sum up, understanding market trends and industry dynamics is essential for evaluating a stock. Macro trends help you understand the economic backdrop, while industry trends give you insight into how specific sectors are evolving. By considering both, you can better assess whether a company is well-positioned to thrive in the future or if it's at risk due to external forces. The next step, of course, is understanding how the company itself is navigating these trends.
Now that we've analyzed the broader market trends and industry-specific factors, it's time to take a closer look at how the company stacks up against its competitors. Understanding a company's position within its competitive landscape is crucial to determine whether it has a sustainable competitive advantage. You should ask yourself, is the company a market leader or is it a laggard? By looking at its performance relative to its peers, you can gauge whether it's a top performer in the sector or if it's struggling to keep up.
Exactly, Ryan. Competitor comparison helps you understand where a company stands in relation to others in the same industry. This comparison isn't just about market share, though. You can use financial metrics, like revenue growth, profitability, and return on investment, to compare companies within the same industry. For example, if one company consistently has higher profit margins or faster revenue growth than its competitors, that's a good sign that it's managing its operations better or has a more successful business model.
Right, Priya. Let's break this down further. If you're comparing companies within the technology sector, for instance, you could look at metrics like research and development, R&D spending. A company that is investing heavily in R&D might be better positioned to innovate and stay ahead of its competitors. Alternatively, if you're analyzing companies in the consumer goods industry, metrics like brand recognition and customer loyalty could be key. Strong brands often command premium pricing and maintain steady demand, even in difficult market conditions.
That's a great example, Ryan. Another important thing to look at when comparing competitors is market positioning. For instance, a company might be focused on the premium segment, offering high-end products with higher margins, or it could be focused on the mass market, which generally has lower margins but more volume. How well each company executes its strategy within its chosen market segment can be a determining factor in its overall performance compared to its peers.
Absolutely, Priya. And this is where qualitative factors come into play too. Sometimes a company's brand strength, its management quality, or its ability to adapt to new market trends can make a huge difference in its performance relative to its competitors. For example, Apple consistently outperforms other smartphone makers not only because of its technology, but also due to its strong brand loyalty, innovative design, and ecosystem integration. These factors contribute to its dominance in the market, even if its financial metrics don't always reflect the same growth rate as other tech companies.
Right, Ryan. So, when you're comparing companies, look at both quantitative factors, like financial performance, and qualitative factors, like market positioning, innovation, and brand strength. By analyzing both, you can get a clearer picture of which company is leading the pack and which might be falling behind. This comparison helps you identify the companies that are most likely to thrive, giving you a more informed perspective when choosing stocks. Now that we've covered the company's financials and market position, let's shift gears and talk about management. Arguably one of the most critical factors in determining a company's success. A company's leadership can have a massive impact on its performance, and researching the management team is essential. Strong, capable leaders can drive innovation, navigate challenges, and make strategic decisions that ultimately influence the company's growth trajectory. On the other hand, weak or ineffective leadership can hold the company back, even if the company's financials are strong.
Absolutely, Priya. To get a better understanding of a company's leadership, start by looking into the backgrounds of the key executives, especially the CEO, CFO, and other top leaders. Have they led successful companies before? What's their experience in the industry? A CEO with a proven track record in the same sector or in leading high-growth companies can be a strong indicator of their ability to successfully steer the company forward. For example, if a CEO has previously turned around a struggling company or grown a business significantly, that's a strong signal that they have the leadership skills necessary to drive performance.
Exactly, Ryan. You want to assess the executive's track record in making key decisions. This includes their experience with strategic planning, acquisitions, and how they've handled the company during challenging times. Look at how the management team navigated crises. Did they make smart, calculated moves, or did they struggle under pressure? A great example would be during economic downturns or the COVID-19 pandemic. How did the company's leadership respond? Did they cut costs strategically, invest in innovation, or adapt quickly to changing circumstances? Their decisions in those times can reveal a lot about their ability to manage risk and position the company for future success.
Right, Priya. Another key aspect to look at is the leadership style. Read about how the executives communicate with shareholders, employees, and customers. Does their leadership style align with the company's long-term vision and strategy? For instance, does the CEO emphasize innovation and investing in new technologies, or do they focus on maintaining stable, consistent returns? A strong alignment between leadership style and the company's goals is essential for ensuring that the strategy is executed effectively.
Exactly, Ryan. Leadership is not just about making good decisions in a vacuum. It's about setting a vision for the company and inspiring the entire organization to follow it. So, looking into the company's governance structure is also critical. A well-structured governance model with a strong board of directors provides oversight and ensures that the company is being managed responsibly. The board should have a mix of industry experts, independent directors, and individuals with diverse backgrounds to provide well-rounded advice and guidance.
That's a great point, Priya. A strong board of directors can act as a safeguard against poor decision-making by the executives. They can provide valuable oversight and help keep the management team accountable. Check for any potential conflicts of interest or instances where the board may not have been fully independent from the executives. Companies with weak or compromised boards may face governance issues, which can lead to poor decision-making and ultimately harm shareholder value.
Exactly. So, in summary, analyzing management and leadership involves looking at the backgrounds and track records of key executives, assessing their leadership style and alignment with company goals, and evaluating the strength of the governance structure. Effective leadership can make all the difference in the world, And investing in companies with strong, visionary leaders who are well-equipped to navigate challenges can significantly increase your chances of success as an investor.
Now let's talk about growth potential. Investing isn't just about buying stable companies or those that pay consistent dividends. It's also about identifying companies that have the potential to grow significantly in the future. Growth is key, especially if you're looking for capital appreciation rather than just steady income. So, understanding a company's potential for growth can give you an edge in picking stocks that will outperform the market. But how do we assess whether a company has strong growth potential?
That's a great question, Ryan. The first thing to look at is the company's plans for expansion. Are they entering new markets, either geographically or by offering new products? Companies that are expanding into new regions or sectors often have more room to grow. For instance, if a company is entering a rapidly growing market, like the electric vehicle industry, or expanding internationally, those moves can significantly boost their growth prospects. Additionally, look at the company's pipeline. Do they have innovative products or services on the horizon? New product launches or technological advancements can drive future growth and create a competitive advantage.
Exactly, Priya. New markets and innovative products are strong indicators of future growth, but they need to be backed by sound execution. For example, entering a new market is a big step, but the company needs to have the infrastructure, resources, and strategy in place to succeed. Expanding into a high-demand region like Asia might be promising, but it also involves challenges such as local competition, regulatory hurdles, and cultural adaptation. So it's not just about the company's plans, but also how well they're positioned to execute those plans.
That's a great point, Ryan. Another factor to consider when assessing growth potential is how analysts view the company's future. Analysts often provide projections and forecasts based on the company's performance, market trends, and industry conditions. If analysts have a positive outlook on the company's growth, that can be a good sign. But it's important to remember that these projections are just that: projections. They are based on assumptions and can be subject to change depending on various factors, like economic shifts or market competition.
Exactly, Priya. When looking at analysts' projections, pay attention to how realistic those projections are. Are they based on solid data, or are they overly optimistic? It's important to dig deeper and evaluate the assumptions that underlie those growth estimates. For example, if analysts expect a tech company to grow at 20% annually, are those projections based on the company's historical performance, its position in the market, and its ability to innovate? Or are they assuming growth in an overly optimistic manner without accounting for potential risks?
Right, Ryan. Growth potential is an exciting part of stock research, but it requires a critical eye. You want to look at the company's strategic initiatives, like market expansion and product innovation, but also consider how feasible those plans are. Combine that with analyst projections and a deep dive into the company's competitive position, and you'll have a much clearer picture of whether a company is set for sustained growth. Finally, let's talk about risk management and diversification, two of the most important principles when it comes to investing. Every stock carries its own set of risks, whether it's market volatility, company-specific risks, or economic factors. The key is to manage those risks effectively. Diversification is one of the best ways to do this. By spreading your investments across different sectors, industries, and asset classes, you reduce the impact that any single investment can have on your overall portfolio. It's like not putting all your eggs in one basket.
Exactly, Priya. Diversification is about reducing overall risk while still participating in potential growth opportunities. For example, if you only invest in tech stocks, you're exposed to risks like market corrections or regulatory changes that could hurt the entire sector. But if you diversify into other sectors like healthcare, consumer goods, or even bonds, the performance of one asset class can help offset the volatility of another. Diversification doesn't eliminate risk entirely, but it does reduce the risk of a single poor-performing investment derailing your entire portfolio.
That's right, Ryan. Another crucial aspect of diversification is allocation. You need to carefully consider how much of your portfolio is allocated to each stock or sector. If you have too much exposure to a single company or industry, you're taking on more risk. For instance, if you invest 50% of your portfolio in one stock and that company experiences a downturn, it could have a massive impact on your overall wealth. On the other hand, if your portfolio is spread out, even if one stock underperforms, the others can help absorb the loss.
Exactly, Priya. Think of it like a safety net. Proper allocation can help minimize the risk of a catastrophic loss. For example, a well-balanced portfolio might have 20 to 30% in growth stocks, 10 to 15% in dividend stocks, and another portion in safer assets like bonds or real estate. This approach helps ensure that if one area of the market suffers, you have other investments performing well to cushion the blow.
Another thing to keep in mind is that diversification isn't just about how many stocks you own. It's also about the types of stocks. Having a mix of growth stocks, dividend-paying stocks, and even some international exposure can provide additional layers of protection. Different sectors and regions respond differently to global events, so diversification helps reduce the risk associated with any one specific market condition.
That's a great point, Priya. And while diversification helps, it's important to monitor and adjust your portfolio regularly. As market conditions change, some sectors may become more or less attractive, and some of your stocks may no longer align with your goals. By staying on top of your portfolio, you can make adjustments to ensure you're managing your risks effectively and still on track to meet your investment objectives. To wrap up, researching stocks before buying them is crucial for successful investing. By understanding the company's financials, growth potential, and the market conditions, you can make more informed decisions.
Don't forget the importance of managing risks through diversification. A well-researched, diversified portfolio helps mitigate potential losses and sets you up for long-term success. Remember, stock research isn't a one-time task. It's an ongoing process. Keep evaluating and adjusting your investments as market conditions change. We hope this podcast has given you valuable insights into how to approach stock research and make smarter investment choices. Thanks for tuning in, and happy investing.